Hello, everybody. This is John Blank, PhD, Zacks Chief Equity Strategist and Economist. Today is Monday, May the 6th, 2024. I'm going to go through more portfolio return insights, this time delivered by the top medical stocks and others in a three-part format. So, number one, we will go through the top medical stocks and we will deal with it as a portfolio return dynamic scenario. So, we will put the medical stocks together in a mock portfolio. Number two, we'll look at just the returns analysis across four sectors: retail, wholesale, consumer discretionary, and consumer staples, which we've already discussed at length. We will now include with medical stocks. Part three, we'll go through some portfolio dynamics using a novel mix of stocks to see if we can also learn more about how the risk and return profile plays out for stocks in a portfolio context. So let's get our first disclosures out of the way. These are my views of John Blank and are not necessarily the views of Zacks Investment Research. Past performance is no guarantee of future results. You can read the rest of this at your leisure. Okay, so part one, like I said, will be top medical sector stocks, and it will be about those stocks in a portfolio return context. So number one, we've got top stocks by market capitalization. These are going to be put in either an equal weight or overweight positions. And you've got over here the different types of models. So we got equal weight across Lilly, Intuitive Surgical, Novo Nordisk, HCA, AbbVie, and United Health. Obviously, like I said, these are the large ones. So these are the largest market cap healthcare medical stocks you have. Now, we can overweight them. We can overweight Lilly and Intuitive Surgical, or we can overweight United Health and AbbVie. So that will be your portfolio two and portfolio three. That's here and here. Also down here, we've got the equal weighted cumulative returns and the over and equal weight. So of course, if you had Lilly and Intuitive Surgical, you earned a little bit of better return. So first thing to note is you can in a portfolio overweight the better stocks. To no surprise, Lilly and Novo Nordisk are the strongest stocks. Intuitive Surgical is right there too. That's why we overweighted a third portfolio this way. So at the end of the day, picking a stock in a portfolio from a returns perspective is your best bet. Owning Lilly, owning Novo Nordisk, and owning Intuitive Surgical was certainly the best way. But all of these stocks, note, over this lifetime, which is now 8 years, paid a 20% annual return. So again, simplifying the S&P 500, all you had to do is buy these 6 medical stocks. Standard deviation of the portfolio, it looks like HCA and Intuitive Surgical were a little more volatile, but in general, these are very low numbers. And that's good to see. Other thing down here, correlation matrix. Take a look at United Health, for example. United Health has much lower correlation than the consumer stocks did. At best, it'll get up to 0.38 with AbbVie and ACA, which is somewhat similar to it is a business. Lilly, which is a drug stock, and Intuitive Surgical is a medical product stock, different business and not as well correlated. So keep this in mind. In general, there's lower correlation to stocks here. So in general, if you had it all playing out for a monthly annual returns perspective, where would you likely to have played best? It would have been in the second portfolio with some Lilly and Novo. Excuse me, we got 2.2 a month. Pretty impressive, actually. Okay, maximum number of analysts. So here we've got the tickers for when there's a lot of coverage in stock. You know, there's names like Boston Scientific, Edwards Life Sciences, Cigna. ARGX is a Netherlands-based company. You probably don't know. Amgen, you probably do know. NLM Pharmaceutical, you might know too as well. Now, again, over the same 8 years, this stock in the Netherlands was clearly the leader in 1,700 annual returns. It doesn't make any money, but it has an incredible idea. People love it. That's what's really going on here. This is more a developmental stock. These are more mature companies that are heavily followed. But for whatever reason, keep this name in mind because it is heavily followed and it has a 44% annual Now look here in terms of maximum number of analysts, substantially lower returns. So in the medical context, we do have proof here that just buying the market cap size stocks was the better play. The bigger stocks, like we learned with the Mag 7, was the better story. There are exceptions to that any rule, and ARGX is certainly the exception. Standard deviations for these can be much, much higher. ARGX, of course, was very volatile. NLM was another pharma stock. Those are more volatile. The other ones are a little more volatile than the market cap ones, but not so much. So keep that in mind too. This volatility did actually pay for you much. This one did. Okay, variance and covariance, very, very low here. This is very worth knowing. Not to no surprise, this is where the business model really matters. You get in a pharma stock where you're really focused on a given drug. So down here, when we weighted some of these stocks, weighting ARGX a little more or weighting Amgen a little more, we did see, of course, that if you put ARGX in the portfolio, you're going to get a higher return. No higher return, though, than the market cap ones. Keep that in mind. Maximum number of analysts, not as good a metric for this market than just picking the biggest stocks by market cap. All right, of course, we'd like to do the largest change in forward 1 month estimates. These are names you're not going to know very well. And the returns, of course, are very poor because what we're picking up here is, people moving up negative earning estimates to much less negative, but still negative earning estimates. So this is the story here. In terms of a Zacks rank, in absence of other screening criteria, you're going to get a poor result. And this is what you've got over here. So keep this in mind. Let's go back through. Remember, number one, market capitalization worked best. Those are good, strong numbers. The number of analysts worked second best. And the worst was, of course, largest percent change. And this will work much better over short-term times with more screening criteria. That's what I will tell you. Okay, so when we put all three together, Lilly with Intuitive Surgical, RGX, and Boston Scientific, Anik, and Compugen, you're going to get these types of returns. And again, to no surprise, you stick Lilly in there, you're going to get a better return than the other ones. You can get up to basically 2.3%. So again, let's keep in mind here that, at best, when we were at its point, we got 2.2%. Now we're all the way back to 2.3%. It's very, very modest. And of course, these correlation matrices, take just Lilly across the top here. Lilly actually is a lower correlated stock to all this. So when you do use different criteria together, you do lower the correlation because what is driving the different stocks from an earnings perspective and from a market buying perspective in the institutional space is very different. People buy these riskier stocks for different reasons, more speculation. The bigger market cap ones will be what the portfolio managers out there look for. And of course, heavy coverage means that the sell side is targeting the buy side with coverage. It's always good to know. So once again, nothing we haven't already confirmed, which is the market cap weighted stocks and market cap in the medical sector have been the way to go in the last 8 years. Again, past performance is no guarantee of future results. All right, and that gets us to returns analysis across 4 sectors, not just medical. So first off, I put in the top ones for consumer discretionary. There's Hyatt, there's Lululemon, there's LVMH, the big luxury goods supplier. There's Marriott and Hyatt. You see that Marriott did a little better than Hyatt over the last 8 years. There's Netflix. There's Nintendo, there's Sony, there's Take-Two Interactive. So here you can see, once again, the biggest stock, Netflix, paid the best. Lululemon was next. So LVMH was third. So again, what you're seeing over the last 8 years in the consumer discretionary space is you wanted to play the very big stocks. Here are the periods of time. I don't find this as useful as this whole period of time over here, and I've put for you in yellow the stocks that are really happening. Okay, now let's get into consumer staples. Elf Beauty, of course, you probably know. New York Times, Restoration Hardware. And Walter's Kluwer. Walter's Kluwer is down in South Africa. It's the Napster's thing. And if I look across all of these again, FRPT is the best one, and that is First Pets. I think it's a pet store, and it did extremely well. People were really big into their pets over the last few years. So you did a 1,100% return. And Elf Beauty Cosmetics, again, restoration hardware, the really fancy stores that people like for luxury shopping for their home. You can see that Better Business Model did work in this space. All right. Retail-Wholesale. Again here, Amazon at 430 was a good play, but Builder First Source was a great one at 1,500. Decker's Outdoor here in Goleta, California, actually was outstanding, 1,315% returns over the last 8 years. They were just in the Uggs boots and Crocs and things like that. It really worked well for them. So keep in mind here, those are numbers that you can produce in this space. So now let's get to, of course, medical. Did medical actually produce better results? Well, yes, it did, actually. You got Lilly in here, just like some of the best stocks we looked at. That ARGX was actually the best. So if you did own Lilly and you did own ARGX, you did actually do well. The rest of them are in the twos, not quite as strong as you would like. Teladoc, of course, that's the Kathy Wood play, did absolutely nothing, by the way, 5% in 8 years. Nothing to show for itself. It was a really poor choice. You were much better off with UNH, which is a giant stock, or Novo Nordisk, which was another giant stock. Even HCA did better. Intuitive Surgical, while everyone loved it, was not actually top stocks. There were other ones. ARGX then was certainly better, as was Eli Lilly with its weight loss obesity drug. Keep that in mind. Keep these, remember, this is comparable to this and to this and to this. Keep those charts together and you have a nice returns comparison over the last 8 years. All right, now we'll get into portfolio dynamics using the novel mix of stocks. First of all, offbeat stocks, largely global, non-US. So these are names you probably don't know as well across the space. Yum Brands, of course, Unilever, other names, Oriental Land, things like this, Chipotle Mexican Grill. I don't think that is Chipotle, actually. That's a different name. But by and large here, you can see there are actually really lower returns over those 8 years. Little different timeline, quite just by a month, but in general, much lower returns out in the international space. But did it pay off to go to a largely global stock mix? The answer is no. People didn't buy them. Lower compounded or gross cumulative returns were just super poor, 54% over 8 years. We're better off in bonds than buying these stocks. It didn't matter much, and of course, the higher weighted stocks did work. But I think the bottom line here is that it really did not pay to be in largely global non-US stocks. Looking at these names of why bother, it's obviously clear to me, at least, this was a much better bet than anything like this. Keep that in mind. All right, so in the top stocks from 4 different sectors. So when we get all of them together, Netflix, Paramount, Restoration Hardware, Marriott, McDonald's, Starbucks, Teladoc, and MTD. So these are, again, we're looking only in the forward change estimates. And we've got Netflix in there, and we show ourselves, again, not much to value in terms of this forward estimate. So bottom line here, like I said, with the medical products areas, is you really, over the last 8 years, relative to consumer discretionary stocks and retail, staples, discretionary or wholesale, did not matter. You were better off with big stocks, and that has been true in those characteristics. So that's the bottom point this year, this time around, is just, keep an eye on the big stocks and the big markets. Those are the ones that are going to do well. All right, so we did look into adding the Zacks rank using an EPS growth variable over the last 15 years. Now, when we find here, this is in Zacks rank 1, 2, 3, 4, and 5. 4s and 5s is a kind of a poor set of numbers here, so I would kind of be discounting this. 1, 2, and 3 is what their answers are really interesting. So keep your eyes on these balls. So the standard return in a one rank stock is 2% versus 1.5 for twos and 1.42 for threes. So it really did pay to get a number one rank stock. And the standard deviation was higher, which is how you get the higher return. That is classic Sharpe ratio stuff, information ratio stuff, things like you always hear about. So keep this in mind. Right down here is your real story. You can see over here, this is your number one ranked stuff. Then this is the others that are going along. So what do I think about this? Fascinating, really fascinating. I think it just confirms what everybody will tell you, that higher ranked stocks in our system are going to deliver better returns. There's another one we looked into, unexpected earnings. This was somewhat less successful. I only keep it up because of just kind of due diligence, that we did try some other things, but in general, this was the lesson of this piece, which is the Zacks reg does matter for stocks in a portfolio context. All right. Thanks for attending, everybody. This is John Blake, like I said, and I am the Chief Equity Strategist and Economist at Zacks, and this is for Zacks Professional Services. Get a hold of these slides by calling 866-794-6065. Send us an email at strategycall@zackspro.com or go to the web, www.zackspro.com. We also have a LinkedIn page and a Twitter feed. But over here is what you want. Get a hold of these slides from us. This is the data. We're a data company. This is an information provision for you to pick better stocks, run your portfolio better. 866-794-6065. Strategy call at zackspro.com or www.zackspro.com. Thanks much.